Thanks for tuning into our podcast today. As you know, in institutional real estate, we spend a lot of time on the more well-traveled parts of the institutional portfolio, the four main food groups: office, multifamily, industrial, retail. But we do occasionally veer out into the niches. So today what we're going to do is turn our attention to a corner of the housing market with strong demand and a lot of misconceptions: manufactured housing. Once it was just a fragmented mom and pop business, but it's quietly emerging as an institutional property sector today. Public REITs like Sun Communities and Equity Lifestyle Properties already built pretty large portfolios in it, and a range of private equity firms, which we'll talk about later, and specialized operators have followed. So today we're going to explore what's drawing that capital in, how the economics actually work, and where the risks lie. And to help us think it through, I've asked Drew to join me. Drew is co-chief executive and chief investment officer of Horizon, one of the larger manufactured housing operators in the country, who has spent more than 15 years in the sector. So Drew, welcome. Glad to have you here. For a listener who pictures trailer parks when they hear manufactured housing, can you paint a more accurate picture? What is the asset class in 2026? And who actually lives in these communities?
Sure, Jeff, thanks for having me. I'm excited to be in the program. So trailer parks is the pejorative term. Colloquially, we refer to them as mobile home parks. And I think as the business is institutionalized, you hear the term manufactured housing. But the trailer park is a misconception that has led to a mispricing of the business for quite some time now. People really anchor their expectations and understanding into things they see on television. There's been movies, Eminem's 8 Mile, Netflix's The Ozarks, that really make people think the business is something that it's not. These are actually neighborhoods, communities where the resident owns the home and leases the lot beneath it. It's a wonderful dynamic that increases affordability for the residents who have pride in their homes. And the resident and the landlord are completely aligned because we each own something of value in that scenario. So the most useful comparison isn't an apartment tenant, it's a single family homeowner. The same pride, the same permanence, the same responsibility for one's own home at a fraction of the price. Horizon owns about 170 communities today, 25,000 sites. We do business in 20 states, and the resident base is largely one of civil service, teachers, law enforcement, retail, and across any of the trades. You also see retirees on fixed incomes and families that have been priced out of the conventional single family market. The residents stay roughly 10 years on average, which is longer than many homeowners hold a house. So that permanence contradicts the name mobile home, right? And reinforces what the economics rely on. These assets behave less like multifamily and more like a ground lease or triple net business with a rooted community on top.
And I have to say from personal experience, Drew, they feel like that. My aunt actually used to live in a manufactured housing community. And, when you drove in to visit with her, you could clearly see it was a different kind of community. But when you walked in the door, you wouldn't have been able to tell it was any different from any other single family home. It's really quite lovely. So this once was a very fragmented, locally owned business for decades. But over the last 15 or 20 years, it's become much more institutionalized with public REITs, private equity firms, real estate investment managers, large national operators. What's driving that shift?
Sure, your reaction in your aunt's community is not uncommon at all. That's I've seen it many times. So in an efficient market, investors are real good at identifying profitable or arbitrage opportunities. Manufactured housing is no different. So first, the economics in our business, we're just too good to stay obscure too long. We have a very durable income stream with minimal variability, almost no capital intensity, real pricing power, and a homeowner resident who will not abandon their $50,000 home and largest asset over a $30 rent increase. You put the supply picture over top of that. Almost no one is building new communities. It's prohibitive to finance, challenging in local zoning. So you have a fixed supply against rising demand, kind of the oldest setup in real estate. The business itself is still fragmented. The data is a little opaque, but we believe only about 25% is institutionally owned. So that means there's some meaningful runway for continued consolidation amongst the public companies and larger private companies. But having said that, you got to be willing to put in the hard work to build the scalable business. It is operationally very intensive, which I think is underappreciated. The average deal size is only about $25 million of gross asset value. So there are a lot of paper cuts to build a business, and I have the scars to prove it.
Now, again, you're not alone in this business. I mean, Apollo, Blackstone, Carlyle, Brookfield, Stockbridge, Haven Park, Cal Zeta Capital, Riverstone, Alden Global Capital, Green Court Partners, Pro Holdings, Montgomery Street Partners, Silver Creek Capital, and Sunrise Capital investors are all active in this sector. And they wouldn't be active in the sector if they weren't able to raise capital. So obviously institutional investors are interested in this sector. What's drawing them to the market? I mean, what do they find attractive here?
I think more and more, it's just become very obvious that the consistent cash flow and kind of counter-cyclical nature of the business, and also it being more niche than some of the other mainstream sectors, has really made it, it's almost a darling today to the institutional investor base. But practically speaking, it functions like a triple net lease, but with the benefits of the residents investing in their homes. So the investor or the owner owns the land and the infrastructure. The resident owns the house. So the most expensive, fastest depreciating asset sits on the resident's balance sheet, not the owner's. And consequently, there is almost no capital intensity. The business has very minimal capex, comparatively speaking. The consistent cash flow is largely driven by credit losses that run, about 50 basis points a year, because people are protecting the home that they own, their largest asset, rather than a lease they can walk from. So to take it one step further, a failure to pay rent and an ultimate eviction would essentially be the resident forfeiting their single largest asset, as they would be required to physically remove the home from the community. And in that scenario, it's too cost prohibitive for the resident to do. So that is a very deep and wide moat, right? It's protected by the cost of eviction and moving that I just described, and then also the extreme difficulty in creating new supply. From 2008, and through the pandemic, occupancy and collections in well-run communities barely moved. So I think manufactured housing is about as close to a recession-resistant income stream that real estate has to offer.
So can you walk us through the basic economics? Where does the income actually come from? What does the landlord own versus the resident? And why does that keep capital expenditures low?
Yeah, the mechanics are relatively straightforward. The resident pays lot rent, coupled with expense pass-throughs for water and sewer usage, trash. They maintain the home itself at the community standard, exactly as any homeowner does. The community owner maintains the infrastructure, such as the roads, the water and sewer lines underneath them, and the amenities like a swimming pool or a basketball court. But that's why the CapEx stays so modest, Jeff. The depreciating assets in the homes belong to the residents. The owner's capital goes to the long-lived infrastructure, roads, the utilities, and any home inventory that may eventually want to buy to attract new residents if there's vacancy. This runs about 8 to 12% of NOI a year. The higher end of that range is typically in the early stages of an investment, when the deferred maintenance that's inherited from a mom and pop is being cured. The lower end of that range is as the community stabilizes, sorry. I think if you set that and compare it against some of the other real estate sectors, it's a very favorable picture, which ultimately just leads to more distributable cash flow. And you combine that with just the low turnover. We don't have the slow bleed of conventional rental turnover in our business. The homeowner has sunk real money into a house that he or she cannot easily move, so they don't leave, hence the 10-year tenure. So having these homeowners really results in the cascading effects into the cash flow of low turnover, low credit loss, higher operating margins, and a lower CapEx profile that are really the engine driving the high performance in our business.
So you've been operating these assets yourself for many years. Can you give us a window into what operating a manufactured housing community actually involves day to day, including the unglamorous parts?
Especially the unglamorous parts. So I think that's what's worth dwelling on, because anyone who's just talking about the clean cash flow profile is hiding the business. It's probably less glamorous than almost anything in real estate. And honestly, that's a feature. Ultimately, glamour just attracts more competition and erodes returns, which we have more of. But I think the real work is within property management and asset management, analyzing the water and sewer systems, collections, relative affordability across other residential options. But most importantly, it's a great deal of community management that has nothing to do with finance and everything to do with people. We're not managing buildings, we're managing neighborhoods. 2 a.m. water main breaks, failing septic systems, the lot that slipped below quality standards. I think what generalist capital underestimates is the durable cash flow profile that everyone admires is produced by a real operating business with obligations to real people, right? It looks passive on a page, but it's anything but. The income is durable because someone is out there, rain or shine, fixing water leaks and engaging with the residents. Horizon has about 340 employees who contribute to that overall resident experience and investment performance. For example, we bought a very large portfolio from an institutional owner during the depths of COVID. And there's an industry bias towards adding value through aggregation versus acquiring scale. So some might have thought we overpaid, but actually it's been quite the contrary. We've been very successful. We've grown NOI at about a 10% compounded rate since that period of time. But it's because we focused on things like water leaks and their recovery rates, collections, eliminating third-party contracts, or any redundancy that can be brought in-house. I hope to uncover a dozen deals with this profile. Our investors will love it.
So how is value created when an institutional operator is coming in and taking over an undermanaged mom and pop previously owned community?
So I'll give you a good example. One of the earliest communities we acquired back in 2015 was located in suburban Maryland, a very high cost of living area for folks that don't know it. It was mom and pop owned, capital starved, underoccupied for what it should have been relative to the market. We invested heavily in both and we reaped the rewards, both reputationally and financially. In fact, it was our approach there that actually led to a handful of other deals that were privately owned by mom and pops and allowed us to create a significant economies of scale in that submarket. If you were to look at a map of our portfolio today, you'll notice that it's clustered in geography. That is by design. Those clusters produce economies of scale and revenue synergies that really benefit the business. So the value is actually created through an institutional approach to property management and asset management. Most of these communities were built and run by people who owned one or two. They operated on instinct, meaning they underpriced rent. They never submetered utilities. They absorbed the residents' water sewer bill and any excess consumption. They deferred capital expenditures, and they kept the books in a shoebox on a napkin. And we've actually seen that, surprisingly enough, when we've underwritten deals. So, having a robust property management and asset management function is very important. Moving rents toward, not to, but toward market on in-place residents, marking new residents to market, passing through utilities the way every other form of housing does, and as you cure the deferred capital needs and improve the community, filling any vacancy, putting in real management and real systems, and leveraging the benefits of a scale platform that I just discussed. None of this is exotic, which frankly is the point. It's just very repeatable and scalable, which we benefit from our experience.
Now, Drew, when we were talking earlier, you mentioned the cap rates in the sector have compressed sharply from high single digits a decade ago into the fours today. For an investor looking at manufactured housing now, if I were an investor, I'd be worried that the easy money's gone. And I'd be asking, where in the heck are forward returns going to come from in a lower cap rate, higher interest rate environment?
Yeah, I miss those days, Jeff. You actually have to operate these communities to add value, which has frankly separated the wheat from the chaff and led to some of the competition, kind of exiting the business, if you will, or being less acquisitive than they've been in the past. You're 100% right. The easy money's largely gone. Right? When any asset class re-rates from a high single digit entry cap, to the low fours, a decade of return gets pulled forward. So where does the forward return come from? It has to come from an intense and relentless focus on the blocking and tackling of property management, and enhanced by rigorous asset management to ensure that we are meeting the performance standards we expect and demand. So again, that's moving rents toward market, having tremendous expense discipline and cost controls, utility recoveries, filling vacant lots over time, but also creating customer loyalty that enhances the reputation of the communities and spreads by word of mouth. All of this supports a durable income stream that compounds very well over the long term. How much of past performance was repricing and skill? I think probably more than the industry likes to admit. But that's the whole point about what comes next. The coming decade, I believe, will reward operators and sector experts, not financial engineers.
Okay, well, the sector leaned pretty heavily on cheap leverage and aggressive refinancing during the low rate years, just as the rest of the real estate industry did. But now we're in a higher for longer world. So how exposed is the manufactured housing sector to this higher interest rate for longer environment, which we're forced to operate?
So, I think for better or worse, Jeff, many folks who were in this position likely passed those increased interest expense costs onto their residents. That's an uncomfortable and sobering reality. But, consequently, there really hasn't been any distress in our business. But what separates the durable operators from the fragile ones in a higher for longer environment is really having a sober capital structure, modest leverage with laddered maturities, the use of interest rate hedging, of course, a sensible basis. A buyer at a 5 cap is much better positioned to weather the storm than someone who acquired in the 3s and even the 2s, which we knew of back in the COVID era. But most importantly, I think having genuine operating capability, because when the multiples stop expanding, your NOI growth is the only honest, scalable source of return that you have in our business.
Well, there's kind of a disconnect. It's a great story, but it seems like your value proposition rests on affordability, but the business model depends on readily and steadily raising lot rents, often on residents earning well below local market median income. And there's growing public scrutiny and talk of rent control. How does the industry reconcile these two apparently conflicting elements of these programs?
That tension is real. So product exists because it's affordable, but the business model depends on rent growth. And most residents do earn below area median income. I think pretending otherwise is both dishonest and eventually bad business. So the honest reconciliation starts with the right comparison. It's not last year's rent against this year's rent. It's the resident's real alternative. And for most, that alternative is being shut out of single-family home ownership altogether. This is the most affordable path to actually owning a home in America today, and run responsibly. It can stay that way in your community forever. The payment behavior proves it. There's about 50 basis points of credit loss. It's homeowner grade, not tenant grade. The residents pay because the home is theirs and the cost is within reach. The operators who impose the punitive increases are the ones generating the headlines, the legislation, and the rent control campaigns. And they damage everyone in the business, not only their residents. The durable economics that we enjoy depend on community stability. So a full community of long tenured owners benefits everybody. But a business model that prices out the people it houses isn't a model. It's just eventually a slow liquidation of all the residents. So I think the rent control risk is 100% real and growing state by state. Really, the only durable defense is to be the kind of owner who just doesn't invite it.
Fair enough. So we've already talked about all the players that are moving into this marketplace. Large private equity firms, public REITs, national operators. What does a more institutionalized field mean for returns going forward? And what does it mean for residents in terms of affordability?
Yeah, for the returns, more institutional capital means more competition, right? So higher entry prices, lower forward returns than its early movers enjoyed. So from here on out, the good news though is that any alpha that's created will be purely operational, not like market timing or financial engineering. For the residents, I think it can cut both ways. So scale and professional ownership can mean better maintained infrastructure in communities, more responsive management teams, and capital invested into the community to finally repair the roads that their mom and pop didn't do for 20 years. But it can also mean a colder hand on the rent, right? A distant institutional owner who's trying to optimize a spreadsheet and never actually sees the family on the other side of it. But both of those things are happening at once. Um, so I think the sector's reputation now really turns to which behavior dominates next. The owner who treats residents as a long-term relationship rather than a quarterly extraction tend to perform better and will carry the lowest regulatory or headline risk. So, and for many reasons, how the industry conducts itself over the next few years is in effect writing its own regulation.
So over the last 38 years at editorial board meetings, we hear repeatedly from investors that the most important cut when thinking about who they're going to hire is fit. So where do you think manufactured housing should sit in an institutional portfolio? In what way does it fit? And would you define it as a defensive income play, an inflation hedge, a diversifier, or something else?
Would you be surprised if I told you it's all of those things? So it's durable defensive income first. That's why I think people begin loving the business. Then there's an inflation hedge built in and a genuine diversifier on top. So think of it like an ice cream sundae with chocolate fudge and that delicious cherry, right? So durable and defensive because the cash flow holds up with NOI growth, even when the economy softens. Housing, and more importantly, affordable housing, is the last thing people give up. It's an inflation hedge because rents reset annually alongside a mark-to-market opportunity upon turnover, and the replacement cost of land and infrastructure climbs with everything else. And finally, it's a diversifier because the return drivers, affordable housing and fixed supply effectively, they don't track the major food groups like office, industrial, retail, or the equity markets. I think what the land lease business isn't at these prices is an opportunistic play. Capital that needs a 30% IRR, in 2 years is in the wrong asset class. Manufactured housing suits patient, long duration money that values durability over excitement. So think insurance balance sheets, pensions, endowments. Anyone matching long-term liabilities or focused on compounding income quietly should really be paying attention to the manufactured housing business.
So, a lot of investors are new to this sector and they may not understand what's important when you're underwriting a private manager. What do you think they should be scrutinizing in terms of alignment of fees, track record, operating capability? What's important here? What are the things that they could make a big mistake and would really hurt them? Or if they make the right judgments, it's really going to be rewarded.
So if I were to put myself in their shoes, I strongly believe alignment is the most important. How much of the manager's own capital is sitting alongside the investors? And then the fee structure, does the fee structure and the incentives reward durable performance, or is it just the gathering of assets, right? Are we focused on building a long-term business together or something that's more short-term and opportunistic? To me, I think we should be considering ourselves more like partners in the business together versus just investors for a period of time. The track record is important, obviously, but I think particularly partitioning how the returns were created, right? So you want to focus on repeatable operational improvement and expertise demonstrated through NOI compounding, not cap rate compression, because that's less likely to recur. So I think the factor generalist skip, and one that reliably decides outcome, is the operating capability. So is the manager a specialist with vertical integration that's going to help drive that NOI growth? Or are they just hoping for cap rate compression? I think in a sector where the returns will now come from running the business that we talked about, if you are an owner or a manager that can't operate in that granular way, you are really missing an opportunity for your investors. And frankly, I think given the cost of financing today, the investor's probably well served heeding that advice across most property types. But I think in an evaluation, most importantly for our business, a genuine red flag is if a manager won't speak candidly about the affordability and the resident relationship. Treating residents purely as yield to be squeezed is an ethical liability, a regulatory and headline liability, and eventually in time that will become a financial one, right? How a manager talks about the residents in its communities is eventually how it will treat its partners.
Okay, so investors have long-term timeframes. They have to look out 5 to 10 years. Where do you see manufactured housing as an institutional asset class heading? And what could derail the thesis that we've been talking?
So I think a decade out, the structural case really only strengthens from the solid ground it's on today. Right now, the country's 3 to 4 million homes short. There's no serious plan to build affordable ones at scale. The national home price to income ratio hit an all-time high near 5 times in 2025. And manufactured housing remains the cheapest path to homeownership. Fannie Mae did a study last year that concluded for homeownership affordability to revert to pre-2019 levels, one of 3 things needed to happen. Home values needed to fall about 40%, interest rates needed to fall about 60%, or incomes needed to rise about 60%. Each of those seems highly improbable to me, right? So I think that will prove demand more resilient. And when you backdrop the supply picture of almost no new supply, I think these are trends that are not reversing anytime soon. So that's going to mean more institutional ownership and lender participation, which of course there'll be more competition, but it should result in better operations, tighter financing pricing, better debt execution, and then lower returns for those though that don't have the vertical integration and sector expertise that will allow them to drive the alpha creation through operations and asset management. I think there are 2 things that could probably derail that thesis, and we talked about one. It's adverse legislation. So rent control spreading across enough states to break the income growth engine, that would be a self-inflicted wound that the industry's worked at. Worst actors just inflict on it. The second, and it's honestly a wild card, is someone tracking low-cost new supply at scale and the local municipalities being more constructive on development. That would be a really good outcome for the country, but a corrosive one for the scarcity premium that this business thesis rests on.
Yeah, well, it certainly could happen, but it hasn't happened so far. Look, we recently saw the road to housing bill pass. What impact is that going to have on the sector?
Sure. So it has eliminated the requirement for manufactured housing units to be built with a chassis, which is likely to reduce the cost. The estimates you hear $4,000 to $8,000 per unit. So it should, in theory, make the actual manufactured homes less expensive, which is good news. So that means that there should be an even better path to homeownership for folks. The second thing, and I don't know if it will materialize, but the chassis requirement is the one that characterized the homes themselves as chattel, such that lenders were then lending in a chattel financing relationship and charging rates that were different than you would be charged if you had a mortgage. So now that the homes have the chassis eliminated, there is potential for a lender to consider those homes real property and extend mortgages versus chattel financing. The mortgages would carry a lower interest rate. So it could kind of be 2 positive things, a lower cost for the home itself and lower interest costs. I think the first one is more certain than the second, but yeah, it's positive for the industry.
Sounds like the act's going to be create a brighter future. So if a listener, we talked about a lot of different things today. If a listener were going to take away one thing about whether manufactured housing belongs on their radar screens, what should it be? What's the take home?
So I know I'm biased, but manufactured housing absolutely deserves an allocation in every investor's real estate portfolio. It's among the most, if not the most, resilient income stream across the property types. And that's the structural resilience that we just talked about. This is not cyclical, it's not rhetorical. It rests on three things that I don't think are going to reverse easily. There's a real and growing need for affordable housing that we all hear about every day. There's supply that can't keep up and may actually be falling. And these are residents who behave like the homeowners they are. So those are very strong tailwinds that support the case for a long-term investment and continued allocation into the sector. And frankly, the need for affordable housing is acute and worsening. And again, I know that is a sobering fact, but it will create and perpetuate just an inelastic demand profile that should provide very robust NOI growth over the long term.
Drew, I'd like to thank you for sharing your expertise with us today. You're really representing the interest of dozens of investment managers who've already flocked to the space, REITs, operators, and the investors who are already allocated to the sector, as well as helping educate the investors who are curious about the sector but might not have known much about it. So really appreciate you taking the time with us today.
Thanks for having me.
You betcha. For those of you tuning in, thank you for spending some time with us today. I hope this has been educational and you got some value out of tuning in. Stay tuned for the next podcast. We're looking forward to seeing you.